Welcome to the Ultimate Beginner's Guide to Elliott Wave Theory. In this free video course, you will learn the overall rules and guidelines of the Elliott Wave Theory, how to identify basic market movements, and several wave characteristics that will help you maximize profits. You will also learn how institutional and retail traders use Elliott Wave Theory as a roadmap to understand price action and to forecast significant price reversals before they happen, allowing you to anticipate big moves in advance. And last but not least, cheat code that I discovered over 15 years ago to make Elliott waves 10 times easier to make profits. Make sure to hit the subscribe button and hit the notification bell so you know exactly when new content is released. And also, let me know your questions, thoughts below, or video topics that you want me to cover in the future, as I'll take your comments into consideration and I love hearing from you. The Elliott wave theory was created by Ralph Nelson Elliott. Elliott was an American accountant that began studying the financial markets in the early 1900s. As his theory was based on crowd psychology, it still applies to all markets and all time frames today. This includes the forex markets, cryptos, stocks, indexes, commodities such as oil and gold. The Elliott wave theory is grounded on the very basic assumption, which is the market moves in 5-3 wave patterns. In other words, the market advances 5 waves and then retraces or corrects for 3 waves. This is the central idea from which all the rules and guidelines of Elliott wave theory come from. The 5 waves that advance price in one direction collectively form one impulsive wave, and they are labeled from 1 to 5. And the 3 waves that retrace against the impulsive wave collectively form a corrective wave, and they are labeled from A to C. Notice that the large impulsive wave is broken down into 5 subwaves. The large corrective wave is broken down into 3 subwaves. Here we arrive at the definition of an impulse and corrective wave structures. In other words, a wave that goes in the direction as the wave in the larger degree is called an impulsive wave, and the wave that goes in the opposite direction of the wave in a larger degree is called a corrective wave. In that sense, waves 1, 3, 5, and C are impulsive wave structures because they go in the same direction of the wave in the larger degree. Waves 2, 4, and B are considered to be corrective waves because they go in the opposite direction of the waves in the larger degree. Notice that we have this idea of wave degrees, meaning that waves repeat inside themselves in multiple degrees. In other words, Elliott waves have a fractal quality. In this illustration, you can see the fundamental 5-3 wave pattern repeating inside itself in 3 different degrees. Notice how the illustration begins to resemble price action as more degrees are shown. According to Elliott wave theory, there are 9 wave degrees, and there is a labeling convention to keep things neatly organized. But we are here to make money from the markets, and all you need to know from a practical standpoint is the current wave degree count, 1 degree above, and 1 degree below. More often than not, 2 degrees of wave counts is more than enough to make consistent profit from the markets. You just need to be aware of the current price pattern and where it sits in the larger degree price structure. I've taught Elliott wave theory to over 600 students, and it's no surprise that most people find it difficult as there is a subjective element to Elliott waves. However, within the last 15 years of trading, I've discovered a cheat code that makes Elliott waves 10 times easier, and I will be covering it later in this video to give you a stronger edge. The Elliott wave theory has different rules and guidelines. Before exploring each rule and guideline, it's important to note that these rules cannot be broken. Otherwise, the wave count is discarded. These rules make Elliott waves very practical if used correctly, allowing you to better time your entry and exits. They will also play a key role in stop loss placement, which I'll go over in a few case studies of actual trades me and my students took from entry to exit. So let's take a look at the main rules of Elliott wave theory first. Rule number 1 is that wave 2 cannot extend beyond the start of wave 1. If that happens, we are not talking about waves 1 and 2 anymore. In this scenario, you would simply reevaluate the market as it tells us something else is happening. Often your stop loss will be placed just beyond the start of wave 1's extreme for this very reason. Rule number 2 is that wave 3 cannot be the shortest waves of waves 1, 3, and 5. And rule number 3 is that wave 4 cannot retrace into the price territory of wave 1. These are simple, objective rules that allow the trader to discard many invalid wave counts, again, making Elliott waves practical to use as a strategy. Here's a real-life example of this with gold. We saw a very clean 5-wave move over a 6-month structure, and then a 3-wave correction as an A, B, C. Then we had a nice impulsive move indicating a direction of a new trend, followed by a lesser degree correction A, B, C. The trend then took off, but then came back down to below the beginning of wave 1. This told us that the market was doing something else. So then we waited patiently for the next setup. And over the next 10 days, we got the second most common type of correction known as a complex ABCDE correction. We will be covering this in more detail, but then the setup, we took the same trade again, but this time the trend did take off. So in the first scenario, we got stopped out for a 2% loss. In the second scenario, we made a 12% gain, netting 10% over a 2 to 4 week period. These 3 rules will already give you a starting point for performing wave counts correctly, as it will help you eliminate many incorrect wave counts. Let's now observe simple examples of wave counts using real price charts so that you can have an idea about the details when we'll deal with real markets. Take a look at this price chart. Pause the video and see if you can detect 5 waves going up and 3 waves going down as the Elliott wave theory suggests. This wave count is reasonable because it doesn't break any of the 3 rules that we established earlier. Wave 2 doesn't extend beyond the origin of wave 1. Wave 3 is not the shortest wave of wave 1, 3, and 5. And wave 4 does not retrace into the territory of wave 1. The impulsive waves can be broken down into 5 subwaves each, although that can be hard to see. Just for the sake of illustration, in this other chart, you can see a clear example of 5 waves going to the downside. It's worth mentioning that Elliott wave rules are exactly the same for bullish and bearish markets, but it's easier to study what happens in bullish markets first and then transfer that market knowledge to bearish market conditions later. One of the disadvantages of Elliott wave theory is that there are many different scenarios in which often gives traders paralysis by overanalysis. Elliott wave academics and scholars are guilty of this by trying to put a wave count on every chart and every scenario, and are more interested in forecasting the markets as opposed to simply making money. The cheat code I will share with you later in this video will shorten your learning curve without having to learn all the possible wave counts, as most of them do not occur that often. We are looking for the most typical and most common high probability pattern structures that allows us to develop a specific trade strategy. We've covered a lot of information on Elliott waves. To help you on your trading business journey, I'm going to share my personal trade plan with you. This is not only going to summarize Elliott waves, but also covers 3 cheat codes as well as my favorite and most successful entry and exit strategies with a checklist, making it easy to apply. You can now download it for free. It's in the description link below. Now let's get into some detail with the easiest of the 3 cheat codes to apply alongside Elliott waves, which is guaranteed to improve your trading results if used correctly and consistently. I'll use real-life trade examples to demonstrate the power of the cheat code. I will focus on high-level principles here as I go into more detail within the trade plan, which you can download for free. Elliott wave theory provides a detailed roadmap for you to navigate the markets, but it's not a standalone strategy. I'm going to show you now how to combine Elliott wave with my personal favorite indicator that is very easy to use. Momentum indicators, they simply measure the rate of change of the price action, but they can correlate very nicely with price itself, indicating when we should expect and anticipate highs and lows. Now, there are thousands of momentum indicators. By far, my favorite and most practical that I like to use the most is the Stochastics RSI, as it gives me the most valuable information. It's consistent and very easy to use. The objective of using momentum indicators is to help identify the larger trend and the smaller trend. This is very similar to Elliott wave thinking, such as the immediate wave count and the higher degree wave count. Why is this cheat code so important? It's because you'll be surprised at how frequently the Elliott wave 5-wave trend coincides with the higher degree momentum, and also how commonly the corrections end with the lower degree momentum reversals. The minimum criteria for a trade setup is a double time frame momentum. This is an objective rule that massively stacks the odds in your favor. The main two time frames I use are weekly charts, often referred to as the higher degree time frame, and the daily chart, often referred to as the lower degree time frame. In other words, the macro rate of change is indicated by the weekly chart, which gives us a big clue of the direction of the major trend. As the saying goes, the trend is your friend, ride it until its end, until it reaches its bend. The higher time frame momentum helps us identify the beginning and end of a trend. Then we will use the lower time frame momentum to help pinpoint the start and finish of these trends. And again, these tend to coincide nicely with the Elliott wave count and will help with your Elliott wave count and confirm or invalidate what is likely occurring in the market. So the summary of momentum: to consider a short trade that is making money as the price goes down, the following minimum criteria must be in play. The higher degree time frame momentum, in this case the weekly momentum, is overbought. That's when both the blue and the red line is above the 75 level of the Stochastics RSI. Or the weekly momentum is bearish and not oversold. That is, the blue and the red line is not below the 25 line. In other words, that indicates that the weekly upside is at or near completion, and the probability is that the price will likely move sideways to down over the next few weeks. The lower degree time frame momentum. Daily momentum has made a bear reversal above the Stochastics RSI 50 line. That is, the blue line is below the red line above the midpoint of the Stochastics RSI. This indicates that the immediate price action over the next few days is likely to be sideways to down. To consider a long trade that is make money as the price goes up, the opposite is true. Using double time frame momentum as the minimum criteria before considering a trade dramatically increases the odds of success in your favor. With this particular trade, we made a 310% risk reward in as little as 6 days. The key to the setup was to identify the wave count. We have a nice clean 5-wave move to the downside. We have an initial wave A, what looked like to be a wave B, which breaking down to an A, B, C structure in a subdivision in its. And we're now looking to go long on a wave C. We can combine this with the cheat code of double time frame momentum. The weekly momentum is bullish, indicating that we should be sideways up for a number of weeks. And we've just made a bullish reversal on the lower degree time frame, which is on the daily chart. Now, as we can see, over a 6-day period, the market really took off, and we made a 310% risk reward on this single trade. So this finishes up the beginner's guide to Elliott wave theory. I hope you were able to learn something new and useful with this video. If you enjoyed the free material I produced here on YouTube, please help support the channel by clicking the like button, subscribing to the channel, and activating the notifications, and leaving your feedback below in the comment section. And don't forget to download my free trade plan. It contains everything we covered in this video and more.